Institutional investors take a very different approach to managing assets than a retail investor. In fact, institutional investors are using data in the market going back to the late 1800s, sometimes even further. They have a very long memory, and that data is studied and new portfolios are managed based on it. Retail investors are very, very different. The average investor just remembers what happened the last 5 years. The market went up, my stocks have done well, let's buy more stocks. Most retail investors don't realize or aren't aware of the lost decade, which institutional investors most certainly are, and you're seeing them react to this in their portfolios. The lost decade was really a period from 2000 to 2015. Both the Nasdaq and the S&P experienced a pretty interesting phenomena that most retail investors can't even comprehend could happen again. After 2000, we had the dot-com bubble burst. From there, the Nasdaq went down to 800 by 2003. That's more than a 75% downturn. And the worst part is, you could always say buy an index and hold it, it will recover over time, and it did. The Nasdaq recovered, but it didn't recover until 2015. So if you were all invested in the equities markets or in the Nasdaq in 2000, you didn't even get back to break even until 2015. And all through that time, you could have been implementing other strategies to generate positive returns across other asset classes. And that's what we're seeing institutional investors do now, move into these other asset classes. We're seeing institutional investors and ultra high net worth clients through multifamily offices really rebalance their portfolios where less in publicly traded equity, moving into other asset classes with low correlation to stocks. It could be things like real estate or private infrastructure, hedge funds, algorithmic trading, even fixed income or private credit or private equity are other asset classes that are not going to share a one-for-one correlation coefficient with the public equity market.